Welcome to Origins, the podcast where we dive into the LP and VC ecosystem and learn how the people behind the capital make decisions.
I'm Beezer Clarkson, a partner at Sapphire Partners.
And I'm Nick Charles, a partner at Notation.
This week, we're speaking with Joanna Rupp, the Assistant Vice President and Managing Director of Private Equity at the University of Chicago, and someone I've personally been a longtime LP fan of, and I'm just very excited to have her come on and chat with us.
Got a lot to cover today. Joanna is an incredible LP, has 20 years of experience at Chicago's Endowment and Pension Fund. I'm really excited to both learn from Joanna about a very holistic view of managing an endowment, and then we're going to dig in all the way down to manager selection, how they think about funds, both big funds, small funds. And we're going to do also a crazy little experiment where you both evaluate me and my new fund, which is not yet announced, but raised, both the pros and cons and what I have to prove. And it's going to be a little uncomfortable for me, but hopefully fun, I guess.
Well, thank you for letting us use you as an example of how an endowment looks at making new investments. I'm excited to hear Joanna talk, as you said, about the endowment world and hearing her sort of talk about what are the foundational questions and things that they look for when investing. I'm really excited to hear more about that from her.
Yeah, the endowment world, I mean, we've talked about this at length, Beezer. I mean, you've done obviously an amazing job sort of uncovering LP land. It feels like endowments are still difficult to uncover, even for me, and I've been at this a while. And in many ways, like, they've always intimidated me, these like sort of amorphous things you have to go secretly find. So I'm excited for Joanna to lift the veil a little bit.
I am too, and I think one thing to say, it's the endowments are all different. I think she'll unpack this a bit for us, but I think one of the things why it's trickier is that fund of funds tend to be very consistent in what a fund of fund is, but a foundation and endowment can be remarkably different internally in how they make decisions and how they put their assets in different places. So I think that adds to I think if you know one, you know one.
The other thing is that if there's newer managers listening to this podcast, we have the rare episode where we have two LPs that are actually making new commitments to new managers this year and in the years to come. A lot of LPs, at least my understanding, is sort of pulling back, shrinking rosters of managers, and Chicago is adding, and obviously you and Sapphire, through the relationship with Counselors, are adding a bunch, actually. So you'll be very popular. I think that'll be really interesting and rare.
Great. Let's do it.
Okay, cool. Joanna, thank you so much for joining us. So excited to have you on Origins today to not only share your LP perspective, but to also help our audience and, quite frankly, me understand the endowment world.
Well, thank you, Nick. I'm delighted to be a part of this.
I'm very excited to be here. I can go on and on about how impressive I think you are, Joanna, and how thrilled I am to be able to chat with you and Nick. I could take the whole time saying that, so I'll keep it short, but thank you very much.
Well, you're very kind, and I will share the compliment. You're one of my favorite LPs to be around the table with.
Joanna, have you spent 2 decades working in pensions and private equity for the University of Chicago, which is incredible tenure. You've seen multiple market cycles, highs and lows across many different asset classes. And aside from Chicago, you have some big names on your resume: Goldman Sachs, U.S. Central Credit Union, Security Capital Group. So by way of introduction, could you tell us a little bit about your life in endowments and maybe what led you to the University of Chicago?
Absolutely. Well, I'm very much of a Midwesterner. I went to the University of Kansas and discovered finance and economics, and I loved it, especially economics. But like a lot of grads, I wasn't exactly sure what I wanted to do, but I had a vague idea of being involved in finance, maybe an area like corporate strategy. And I really stumbled into U.S. Central Credit Union. I led our efforts to expand activities into more nascent markets, including short-term interest rate derivatives, interest rate swaps, and structured credit. I had a great run, then went to business school at the University of Chicago. It was a transformative opportunity that opened a ton of doors. And having come from the credit union, I was really interested in the not-for-profit world and seeing the adoption of derivatives across the broader industry. So I joined the municipal finance group at Goldman, with the thesis that not-for-profits were going to embrace derivatives. And I was recruited from Goldman to Security Capital, which is or was a real estate operating and investment firm. They recruited just extraordinary folks, and I have made some lifelong friendships there. But it wasn't the place that I wanted to build my career. So I took a year off to kind of figure things out and did the proverbial informational interview with the University of Chicago's investment office. And the person I interviewed with told me, I think you'd be perfect in an endowment. But about 3 weeks ago, we made an offer to someone. So I don't have any openings, but I'll try to keep other opportunities in mind. And then about a week later, she called me and said the person had reneged and asked me if I wanted to come in.
Wow.
Wow.
Yeah. I mean, it was kind of just extraordinary. So I came into the office and interviewed for a position as the manager of public equities and quantitative research. So I did that for about 3 years, and I moved into the COO role where I oversaw the pensions. And then about 13 years ago, I was asked to move over into the private equity portfolio. And it's just been a great place to spend my career.
That's amazing.
Joanna, I don't know if you know this. My first job out of college was trading credit derivatives at Lehman Brothers. I guess we didn't overlap at that time. This was '07, but we were maybe trading partners in another life.
This will date me. My first week on the trading desk was the crash of October '87.
Mm-hmm.
So
mine was the crash of '08. So we timed the crash well.
I started venture in 2000, pretty much March. So there we go. Nothing like starting during a crash.
Some good learnings in there.
absolutely.
Could I ask you to continue to expand on the endowment world? I'm constantly intrigued by how endowments work. I think it's a tough world to understand, and it's not always explained because there doesn't seem to be a reason why it needs to. It's not a knock. I think it's just opaque and like many things in the LP world. Would you mind walking us through it? Because you do both a school and a hospital.
We do.
Correct.
Yes. The University of Chicago and the many different parts of the university, including the hospital. So one of the first things for most endowments, they are set up kind of like a mutual fund. So all of the different schools and entities will own units in what we call the total return investment pool, TRIP. So all of the different entities own shares in TRIP. And the objective of most endowments is to support the organization with annual distributions and to grow the corpus to support future generations. So it leads to a lot of kind of distinct and unique characteristics. The first is we don't have a set liability. Unlike a pension fund where you have your liability for future payments to pensioners on your balance sheet, our liability isn't on our balance sheet, and it is variable. Most endowments target a payout rate plus inflation. Our payout rate is between 4.5% and 6.5%. So if you add inflation on that, you're looking for a nominal return of 8 to 8.5%. And one of the things you learn in endowments, bigger is better in the endowment, not asset managers, but for an endowment, bigger is better, or at least that's what the administration and trustees think. So, ideally, we return the 8.5% and we're able to add a little bit more on top to help continue to grow the endowment and support the institution.
Does that include donations?
That is actually an interesting point. And that is largely what can distinguish an endowment from a foundation.
Okay.
So foundations don't typically have donations and inflows, whereas for most endowments, that is an important part of the organizational structure and impetus. And in fact, like many universities, we have hundreds of people who are on the ground trying to help us garner those donations.
Right. So 8.5% sort of gets you to break even.
Yes.
With the costs of the university and the hospital and other parties. And then in theory, the donations would grow the endowment. In theory, I realize it's very rough math, but in theory.
In theory, and oftentimes when donations are made, they're for current expenditures. So there is some portion of a donation that typically is spent currently, and hopefully some part will come into the endowment.
Right.
And if you're endowing, for instance, a chair, then a significant portion would come into the endowment.
I know everyone can pick their own portfolio allocation. But when you think of, and if you're willing to share how Chicago does it, how do you then balance the publics and the privates and any other asset class you want to be in? Because I'm sure it'd be lovely if you hit 8% every year. I don't know how realistic that is, but the net goal of all of it is to produce that on average annually. And how does one assess that? And with a little particular attention to privates, but given the public market these days, maybe both is interesting commentary.
I'm going to divide my answer to this question in a couple different directions. And first, I'm going to start with kind of the governance and the oversight. So most endowments are overseen by a portion of the board of trustees. And in our case, there's an investment committee to which we report. And that investment committee, the range of their responsibilities can be very broad. In large private institutions like ourselves, typically the investment committee has more of a macro view. So for instance, in our case, we're very much of a staff-driven model. So staff will make a recommendation on the asset allocation to the committee, but the committee is responsible for approving that asset allocation. They also approve generally the payout rate and other kind of more macro elements to kind of guide us. So in our case, it's the asset allocation. Being the University of Chicago, we also use a quantitative measure of our sensitivity to equities, and that is the beta. They will approve our overall exposure to illiquid and liquid assets. And then, of course, they kind of oversee the staffing. In some models, the organization will use an outsourced CIO. And in that case, the outsourced CIO drives the asset allocation. Sometimes it will be a staff model augmented with a consultant, whereby the consultant really drives a lot of the activity. So that's part of the reason, Beezer, it's probably hard to understand, is there's not necessarily any single model, but typically the governance structure will approve that asset allocation, which then determines how much of your equity risk is taken through the public markets versus the private markets.
I have a slightly different question, maybe a different way of framing this is, let's say the return target for Chicago is 8% or 8.5%. And my understanding is, like, historically public market equities, like if you're just to invest in the S&P, I think historically returns like 7%, something actually pretty close to 8.5%. Clearly uninformed LP question, but like, why not just invest in the S&P? Like, it gets you pretty close. There's like way less risk. It's way more liquid. Or like S&P and maybe a little bit of something else. Like, why invest in a lot of something else that has a lot more risk?
You've got your kind of liability rate, which is maybe 8.5%. But everybody wants the endowment to be bigger. And this is, kind of where the endowment model was developed. Previously, it was passive or neutral benchmark of you set your equity risk and you would potentially invest in index funds or public markets. To get diversification, you would own bonds, right? And that was the portfolio, maybe a 60-40, 70-30, 80-20 if you were being really aggressive. Then came the evolution of the endowment model, in the early 90s, late 90s. And it's not for everyone because you are taking a lot of risks. You're locking up your money. You have to do manager selection. There are a number of different factors I believe an endowment should consider as they decide whether or not to embrace the opportunities in illiquid markets generally and in venture specifically. And one of the things I would say about venture specifically is if you're not able to access the top managers, you really aren't paid to be in the asset class. We'll talk about our cost of capital being at least 15% because we have a very strong buyout portfolio. So if we're going to lock up our money, we really want to make sure that we have the opportunity to earn, 5-7 times or more on our capital.
So much to unpack there.
Well, I was going to say, when we set the asset class, we actually have at Chicago, we have a strategy team and a risk team, and they go through and they do the math, Nick, to your point, to say, if we have this sort of an asset allocation, what is our long-term expected return? And we back into what that asset allocation should be to achieve our investment objectives, to maintain sufficient liquidity to meet the needs of the institution, even during a downturn. And to also think broadly about the capital market opportunity set. And that's one of the things I think LPs love about this job is the world is literally your oyster. You can go anywhere globally and you can consider really any asset class. And if you've got savvy investors and you've got the right governance structure, you can actually embrace some areas that are a lot less efficient and require a little bit more I was going to say kind of daring maybe to go into. And again, it is related to your governance structure.
Can I dig in a bit more on that? You were kind enough back in 2020 to talk to Business Insider and said you were bullish on venture capital as an asset class in particular in your portfolio. And you had a long-term view that venture would be a very strong performing asset class. And obviously a lot has happened in the last 4 years. And we are in a bit of the doldrums when it comes to exits for private companies going public or M&A, and maybe the public markets, maybe you own some NVIDIA stock or something else. So the public markets could be just fine for other areas, but it's definitely been quiet on the private market exit side. Just curious to get updated thinking on how you're feeling about that. And I love investing with you as a venture investor. So I know you're active in it, and just unpacking that would be awesome.
We had a list of topics, including that question on how good I was at forecasting the relative performance of different capital markets. And it was a good chance to take a step back and say, yeah, 4 years ago, I did say I thought it was one of the best places to be.
2021 had a lot of returns.
It had a lot of returns. And I will say, and I'm sure you guys both know this even better than I do, it takes a long time for a venture portfolio to mature. So I'm thinking I have at least 4 more years to prove out my crystal ball gazing. It does take a long time for these funds to mature and for the companies to mature. And I didn't foresee the avalanche of capital being thrown into the VC world, which did distort valuations and led to some very poor behavior, and a lot of capital was squandered. But when I come back to the foundations of venture, right, you are going to have great world-changing companies being built. And we are at a period of time where technology is evolving rapidly. I'm actually, how many minutes into this are we? And I'm now just mentioning AI. AI is the thing that everyone's talking about, but there are other game-changing things happening in the world, be it robotics, personalized medicine. If you think about the world where companies stay private even longer, the only way you can access that innovation and the wealth that is going to be created through those markets is through the private asset classes. And it feels the pace of change is just accelerating. I think venture should be a foundational piece of really any institutional investment portfolio, assuming you can execute appropriately. And I think that means taking a measured pace of committing capital, identifying strong long-term relationships, and you have to be committed to the asset class. You really have to take a very long view.
Well, don't feel bad. I remember doing an interview in 2020. I think it was, April, right when COVID was hitting. And I think I predicted it was going to be a total train wreck for venture that year, and that no one would be able to fundraise, and it was going to be awful. And instead, money poured on people's heads. So there you go. In the long run, I'm in your camp, but the short run is very hard to call.
It is. That's why I like being in the private equity side of the portfolio, not the public markets.
Amen.
So I'm curious why invest in small firms at all. Many endowments of Chicago size just don't do early stage small funds. And so drilling into kind of venture, how do you think about that full spectrum?
So when you think about large multi-stage funds versus smaller managers with more focus, the specifics of the analysis and evaluation that we do vary, but the foundational questions are the same.
Okay.
Is the GP an aligned partner do they really understand that partnership? Is their investing track record good? Or if they don't have a track record, are there elements that we can align that say we expect them to be able to deploy capital in a manner that's really going to be needle moving? And will that edge be sustainable? And can we partner with them for the long run?
Mm-hmm.
If we don't think that it's a tremendous amount of work to build these partnerships, we want to make sure that it's not just a one fund wonder, that we're along for, at least 3 or 4 fund cycles. And then the other thing that we try to evaluate is really the portfolio construction approach. So does the manager understand that they have to deliver multiples of capital and they actually have to get liquidity at some point?
Mm-hmm.
So the specific metrics will vary depending on the size of the firm and the focus, but those are the foundational questions we're trying to answer.
What does misaligned look like? Because like aligned, I'm like, just from my perspective, we both want to make money. We both want to invest in great companies. I get the point on longevity. Like ideally, you want to make sure that a GP is doing it for a long time. But like, what are examples of misalignment?
So there are circumstances where the GP can make a lot of money and the LP may not make much money. Really asset gatherers, right? Folks who are going to be paid on management fees.
Okay.
Or they have a whole bunch of SPVs.
Okay, got it.
And the glory of SPVs for managers is there's no cross carry. You have one SPV that does great. You guys collect. If we're in both of them and the second one does poorly, we can lose a ton of money on one and give a lot of the upside on the other. It also goes to terms like transparency. And one of the things that really bugs me about venture is that there's no hurdle. We have a cost of capital. VCs don't have a cost of capital. So there is oftentimes, or there can be an incentive to hold assets and just hope that they accrete and you get 20% of the upside. And you may not be making, you may not be returning the 15% net on that decision that we're really looking for, at least.
So I'm old enough to remember when venture did have a hurdle. I mean, and it was more of a European style. Yeah, I know.
Okay.
Back in the day, you had to return the cost of the capital to the LPs on a net basis before the carry would kick in. And it was like a flat 20%. There wasn't fancy step ups. I know. Those old days. Nick has now run away.
Oh, sorry. Yeah, I'm out. I'm out. That's it. Well, I have a view that like every asset class has its own version of a scam.
Say more.
So like the hedge fund scam is you can make like a ton of money one year and you get 20% of it. And then the whole thing goes to zero the next year. And like, there's nothing the LPs can do. The private equity scam, I don't know if this is still true. So you guys can correct me if I'm wrong, but like you buy a company, you dividend out a bunch of money. Doesn't matter what happens to the company. And, you can destroy a company and still make a lot of money. The venture capital scam is locked up capital for 10 years. You're taking fees on it for 10 years, and there's no hurdle.
I really think the average fund life is more like 17 to 20 years.
Sure.
Right. So, And then, of course, the fees step down, but so rises the conversation of continuation funds, which I will not take us down that rat hole on this podcast. But as an LP, you can experience paying fees for a long time from a drag on the cost of capital.
And that alignment and that kind of partnership mindset, Nick, is so important for all the reasons you just mentioned. Once we sign the LPA, there's very little influence that LPs can have.
Yeah.
And I've seen it happen, right? So you really have to know that the GP partner has good intentions and is a partner, because your documentation isn't really going to save you.
Yep. By the way, I feel the same way about founder VC relationship. There's a lot of talk about, VCs screwing founders or whatever, but like there are methods via which both parties can hurt one another. And so I think, there's a base level of trust. We're in this together. We're going to take care of each other. That's really important. We're going to try a little exercise here. This is an experiment. We've never done this. I'm going to use myself as the example of a small emerging manager, small fund. And we have not announced this publicly, but I guess this is sort of it. So there's a post notation new firm that I raised recently as a solo GP with some new team members. This is not meant to be you're doing great, we believe in you. This is meant to be like looking back, like what were the key pieces of diligence analysis? What are the unknowns still? What do I and we need to prove in the next few years for you guys to invest again? And maybe a little bit on how newer managers build a relationship with both of you, approach both of you, and think about, pitching each of your respected firms.
You said to skip all the parts of all the accolades. So I'm skipping it, but that doesn't mean to say they aren't there in spades because
it'll be too uncomfortable. So we'll skip that.
You're already blushing. This is quite amusing.
Yeah, exactly.
So I think one of the things that I have always deeply appreciated about you as an investor, because when we were underwriting you for this fourth fund, as you said, it's a solo GP. So the focus is on you and who are you as an investor, is you've always been the sort of catchphrase as a first principled thinker, which I now use, but I've mostly tried to avoid using because I don't think it says anywhere near enough the depth. But I've always known you to be someone who's like, hey, let me think about what's going on and come to my own conclusions and pull together the data. And it might be the same data we all have, but you look at it and say, given this, here's what I want to do. And here's why I am doing it. And venture is a very hypey, memey, pick all the other words that you want to. And it's become even more pronounced to me over the time that I've been doing the LP investing, how significant it is for someone to come to their own conclusions and how probably even more important it is at pre-seed. And you've said this to me, which I was like, oh yeah, we should have been writing that down in the beginning. Mm-hmm. It's your job to be out ahead of those curves, right? Everyone else could then pick up AI now if they want to, or whatever. If you're a growth investor, it's all laid out there for you to look at. But your job, Nick, is to see the unseeable before it comes around the corner. And I frankly have no idea how you do that. That is some awesome magic that must occur. But I remember you said that in this meeting we had with you in the summer, and I was like, oh yeah, shoot, should be writing that shit down. Like, this should be part of our framework. But it was the thinking that you always had. I think I'm going to sort of triangulate around and just say that's been true. And I've known you now, I feel at least a decade, if not longer. Would have to go back to the beginning notes. But that's why when I first met you, you were at BetaWorks. And I was like, oh, this person thinks differently and is observing the New York ecosystem. And we were interested in the New York ecosystem. And it was that trend line that has continued.
It's so interesting, Beezer, that you, to a certain extent, see around corners, because as I was preparing for this conversation, that was one of the characterizations I was going to use about Nick, is that I think, Nick, you will be earlier into some cutting edge areas and kind of edges than many of our managers are. And that was exciting. You do think differently than many of our other relationships. For our portfolio specifically, we have seen New York as an emerging ecosystem. And certainly now you can invest anywhere because you can do Zoom anywhere. But I still think that boots on the ground make a difference. And when we add a relationship to our portfolio, one of the things that we look at is the overlap. And if there's too much overlap, it's probably not really additive. So we feel like you give us some exposure to a different geography, to some more cutting edge opportunities. And while we haven't had the distinction of investing with you for the last decade, our team has gotten to know you certainly over the last 8+ years. So we've got a real sense of the fact that you care deeply. I think you do have that and embody that partnership mindset. You also have a very long runway, which is important as we think about adding new funds and new managers. And I know a lot of folks don't like kind of the solo GP. We kind of just love the fact that solo GPs rarely break up with themselves. And it's easy to tell who's led and done the investment. And you had a really strong investing track record. So those are the elements that led us to be excited about partnering with you, or many of the elements.
Okay, this has been way too flattering. This was not the point. How about things that you would look for a manager like me? I view this as a new fund one to sort of prove in the first few years. I've never taken any capital or checks for granted. I know LPs can often back managers for a long time, but let's just say like this is the only check I'm raising from Sapphire in Chicago. Like what are the key things that you're going to look to me to prove in the next few years to warrant additional capital?
I do know we talked about this when you came in to meet the team. The competitive landscape in New York is significantly different, right? Because back when Notation started out, one of the things that we thought was awesome about the ecosystem was that really there wasn't a lot of competition because the angel ecosystem, I don't know what the angels of New York were doing, you would know, but they were definitely not doing all of the tech investing that the angels of Silicon Valley were doing. You were by far and away one of the first institutional pre-seed funds. And you are still one of the few that have kept a smaller size, right? I'm not sure if the right word's disciplined or right sized or whatever word we want to use, but there are a significant number. You can tell me the count. We've lost count. There are so many more funds in New York. Nor is it restricted to folks coming to New York to invest. As Joanna said, anyone can get on Zoom. And we've seen an increase in our Bay Area portfolios. Just for example, like the Bay Area based GPs investing in New York. Some opening offices, some just flying back and forth, some just Zooming. Pick your poison. So all that means the world is very different for you. And as one invests now, you've moved from a collaborative check to a lead check. So the stereotypical thing an LP will be looking for is how do you compete and win? Because the bar gets raised. If you're going to, have these multi-returning funds, how are you going to pick and how are you going to get your check and how are you going to get there above the stampede of people trying to get there?
This is kind of contradictory. Are you doing what you said you would do? So, is there consistency in what we underwrote you to do? And are you being adaptable enough or agile enough to understand changes in the landscape and opportunity set and to still deliver to our portfolio what we expect in terms of multiple and capital? So you have to be the same but different.
Easy. And you guys would primarily evaluate, particularly competitiveness, doing like mostly by actually looking at the portfolio, like meeting the founders, understanding why they picked us, understanding the quality of the companies. As you guys are maybe diligencing fund two, primarily that's by meeting the founders and looking through the portfolio.
Absolutely. It's a little bit different in your case because you have the prior funds from Notation. But generally, when we're in a fund one or fund two, it just takes years before you actually can look at the numbers and say they mean much. I think the Cambridge data would say that, funds move through quartile rankings at least 7 years before they settle out. And most VCs aren't on a 7-year fundraising cycle. So in those first, if we back fund one and you're doing what you said you were doing, we'll do some validation. And that is reference checks with founders, which are incredibly important. And understanding, we look at ownership and price discipline of portfolio construction, as well as the strength of the underlying companies. But again, if you're in a pre-seed or seed fund, it's hard to tell in the first 3 or 4 years.
On the third part, advice for sort of newer managers, how would you recommend they get in touch? Like, do you respond to cold emails? Is it all relationship driven?
We do get a lot of cold inbounds, and we try to review the materials, but you just don't have time, right? You just don't have time. And we don't add many relations. Now that the portfolio is pretty mature, it's more or less one in, one out. So we have a few areas where we know there's some white space that we will fill in. Sometimes that can be geographic, a sector or area specialty, or a different kind of network that we're not really exposed to. But the best way to get in front of LPs, if you are able to, is through warm introductions.
How many new relationships will you each add this year, you think?
So we're helping to build a portfolio for CalSTRS for their emerging manager program. So our new ads right now are going in there. So I don't know, somewhere on an annual basis, we'll probably do 8 to a dozen commitments for them. And some will be net new. Some of them are re-ups. But that's building a new portfolio, right? Because at some point, even a fund of funds can become established because the idea is to repeat invest in Nick, right? So if that's the slot in the next fund of funds, it doesn't necessarily mean there's room for a net new ad. There are some times, like when Joanna was saying back in the beginning, the endowments will be creating a new roster too. So it's an intersection of where the LP is in their portfolio construction.
And maybe this is one hint for VCs, which I didn't even think about until you just mentioned that, Beezer. When you see turnover in an endowment office, either at the CIO level or the asset class level, that is often an interesting time to engage because people come in with different biases, potentially different objectives, and it can be an opening to begin to create a dialogue.
I will underscore that because we do both emerging and established managers. So we see where rotation is in the LP base in both sets, and CIOs coming in and going out can be a rotation in the LP base. And in fact, shout out to, I don't know if folks read Ted Seide's blog at Capital Allocators. He wrote this great blog, I don't know, like a month ago. We can link to it in the notes. He's probably saying things, Joanna, that you're like, yeah, I know, I live this. But the arc of the CIO and the team and when the best points to engage are, it was very helpful on the breaking things down, which are just not obvious from the outside. So given your experience it is investing and you've got these tippy top, best of the best GPs that are franchises, which I don't even know at what point you become a franchise, but it's clearly not day one, and how hard it is to get, even by our math, from a fund 1 to a fund 8, which doesn't even guarantee that you're a franchise. It just puts you in the established category. And it's, I don't know, barely 10%. Maybe you have to go back and look at the numbers, but it's very few. What would be your advice to Nick and the other emerging managers on the things to do to set yourself up for the best possible success to be a franchise? I don't know if there's a critical 3 things. That would be lovely if it was that simple. It's probably not. But what your advice is would be awesome. And it probably applies to LPs. So I'm going to listen to, because I'm sure there's a franchise version of being an LP.
I would say take a long view. This is a very long game. And creating a franchise is a long-term process. You're not going to create a franchise without great investment returns. It's just not going to happen. So figure out what your edge is to generate those awesome returns. And be a good person, because it matters. Good people will stay in the game with other good people. Everybody's going to have hiccups. And, when we have a manager who hits a speed bump, we don't want to bail, and we've got to believe that the GP is going to be a good partner for us, and that they are learning from whatever the speed bump is.
Excellent. Thank you. It has been so wonderful having you. Thank you so much for making the time. I know your days are very demanding.
Thank you. It's been a real pleasure. Love being around the table with you guys, and I learn a lot. So please keep doing the good work in Origins.
Thanks for listening to Origins.
If you liked what you've heard, please subscribe to Origins wherever you listen to podcasts. Please rate and review the episode and give us feedback. We love to hear what you're thinking.
Origins is produced by Sapphire Partners and Notation in partnership with Pod People.